Thank you, Madam Chairman. I think we all agree China's currency is undervalued. There is some real question about its impact on the U.S. trade deficit and real concerns about the impact of raising prices on U.S. consumers. It's also important to note that that's equally important that we not allow that one single issue to overshadow concerns we have with intellectual property rights, protection in China, subsidies, and other issues such as protecting investment and Chinese barriers to U.S. exports, especially in light of the view this Congress and White House has not pursued pending trade agreements that could create over 250,000 new jobs in America by ratifying agreements with Panama, Colombia, and South Korea. A couple thoughts. One, I appreciate in your testimony your reference to the commercial real estate market. I still am convinced that there is not a real differentiation in the Fed and the other banking regulators between growth markets in regions and contracting regions. I'm concerned that there's not an understanding that community and regional banks have picked up the demand left unmet by the fall of the CMBS region. And the inflexibility of bank examiners, I'm convinced, where today in the real world, among banks, there is a clear statement. Commercial real estate loans are problem loans. The sooner you get them off your books, the sooner you contract that portfolio, the better for us. The result of that, I believe, is that we're going to exacerbate a problem with more than $1 trillion of those loans coming up for renewal. I do appreciate the effort that you are making. In fact, you had representatives at a recent roundtable this week with some of our most sound banks and real estate leaders in the Houston region. Appreciated the fact that you're listening to those concerns. Two thoughts: independence and monetizing the debt. You referenced the deficit today in your remarks. It's so critical. Will you, it's reasonable to expect the administration to press for easy money in the hope of artificially lifting output and employment in the short run. Will you resist the pressure to monetize the debt as rising borrowing costs intensify our federal budget problems?
Well, Congressman, first, absolutely we will. Our holdings of Treasury securities today are about the same as they were before the crisis. We have not monetized the debt, and we will not. And we will, of course, continue to make sure that price stability is central to our objectives. So let me just assure you on that point. Let me just add parenthetically that given the structure of our debt, it wouldn't even help. It wouldn't even help reduce the debt if again, we will not do this. But given that so many of our obligations are either short-term or indexed or are real obligations such as medical obligations or Social Security obligations, which are indexed, it wouldn't have a substantial effect, even if there were a willingness to do that, which of course there is not. So there really is no alternative but to try to find real solutions. Inflation is just not an answer, either for economic reasons and just because it wouldn't even affect the balance very much.
Well, the reason I noticed OMB's projections on Treasury note yields for the next few years is much lower than what is already occurring today. So I think that pressure will increase, not just from the White House, but from members of Congress. I worry about the independence of the Fed. I wanted to ask you, obviously, we're all aware of the Senate bill dealing with making major changes to the Federal Reserve, such as making the President of the Reserve Bank of New York a presidential appointee, removing certain voting rights, and transferring your jurisdiction of certain banks. Do you have any concerns about making the President of the Federal Reserve Bank of New York a presidential appointee?
Yes, I don't think that's the right way to go. I think we want to maintain accountability through the Board of Governors, which then oversees the system, and that is really the appropriate way for us to be accountable to the Congress, which we will be. We want to be completely open, transparent to the Congress on all financial matters, but we do need to maintain our independence in our policy decisions.
Do you feel like some of the changes, such as voting rights and at the regional reserve banks, do you think those changes, do you have concerns that they could weaken the regional reserve banks and could undermine the independence of the Fed in dealing with monetary policy?
Well, I think that our FOMC structure, which was created in late 30s, has worked pretty well. It's got a good combination of presidentially appointed Senate-confirmed governors here in Washington and Reserve Bank presidents around the country. There are 19 people in the FOMC, 7 governors and 12 Reserve Bank presidents. We all come, of course, to every meeting, and everyone's views are heard. So notwithstanding the voting arrangements, it really is a collective decision, a consensus decision. And so I think we get both the Washington perspective and the Washington accountability, but we also get very important information and input from around the country. And you mentioned this earlier, Congressman, that one of the sources of that information is our oversight of state member banks, which are very well informed about their local economies and therefore a very important source of information for us. And so that is also a concern that we have, that we would lose that, that oversight. So the independence is very important, and I think the main issue here is just to make sure that we are allowed to take actions in pursuit of our mandate without intervention by either the Congress or administration.
Thank you, Mr. Chairman.